All right, Mark. So I've been hearing some grumblings or some talk in the insurance industry that we're getting ready to start or that we're in this first stages of a hard market. So what does it mean by a hard market? What is a soft market, hard market when it comes to insurance?
Well, a hard market's generally driven when the insurance company is not making a good rate of return on their premium to pay claims and expenses. A soft market is generally when they've got more money to invest into insurance exposure coverages. Soft market's usually driven by a higher rate of return on interest. Profitable underwriting means that accounts perform well for the premium that they receive, or a company cuts expenses through computerization or where they combined offices and lower staff, that type of thing. Okay, so a soft market is usually to the consumer's benefit because they are looking for ways to put their money out there to get it working for them through the insurance. And like I say, usually there's a cutting expense or an increase of income via rate of return through stock market or interest or whatever. The hard markets, when they turn around, they're just not making as much money and they start pulling back in. You know, if for every dollar that you put out there, you lose you lose a penny on every $1.01. How many dollars you want to invest? And then that says, okay, we're losing money either because of lack of investment return or that our portfolio is not performing to where we can pay expenses and get our benefit back or get our return on our investment. So then they have to usually raise rates, or the first thing that happens is they start cutting out the exceptions in a hard market. Something that that's not in their wheelhouse usually that they will do in a soft market when they're trying to get that money out in there and get it in use. They will write things or insure things that they might not have a lot of comfort in or expertise in, but they'll go ahead and put it out there. So usually the first form of a hard market is they start doing away with exceptions. They go back to their basics. Second thing is they start raising rates, and then that runs until the cycle turns and they have money to invest again, either through surplus or return or something like that.
So soft market consumers would notice maybe some better rates. Mm-hmm. There might be more exceptions, or it might be easier to find insurance with X, Y, and Z company.
Exactly. Where in a hard market, maybe that risk that has a higher exposure would go to what we call an excess or surplus line, usually a higher rated or higher premium charged company that charges more for that exposure.
And what do you mean by exposure?
Amount of coverage.
So I guess
you just use a restaurant for example. Okay, restaurant has a high fire hazard because of the cooking, right? They have a high hazard on liability side of slips and falls. Somebody spills coffee on the waitress spills coffee on somebody, or the food is not safe, it's contaminated or not prepared properly or something. So a restaurant is kind of one of those risks that has a little more exposure, a little more to it. So in a soft market, there'll be more companies willing to put that money into that because it's not terrible, okay? It's not like a dynamite factory. But they'll be willing to put that in there, and then as things get hard, they'll pull away from that when say they were a company that wrote a lot of contractors where they had a lot of expertise, a lot of comfort in. Well, then they would pull back and say, we forgot this amount of money, we're just going to put it in those contracting class codes where the contractor's type of business that we know we have a comfort level with. And then in turn, that restaurant has to go find insurance through somebody else that charges more for the exposure for the building, the liability, and so on. So
in theory, it should be less expensive for like an accounting firm for their insurance for that exposure than a restaurant.
No, exactly, because the chance of a fire is less. The chance of a liability is less on an office exposure. You know, if you got a manufacturing class, you're going to have a chance of your product being defective and hurting somebody or damaging someone's property. Anytime you manufacture or build something, you have a higher exposure than an office exposure.
So, along those lines of the hard market, talk about reinsurance and talk about how the hurricanes and the wildfires affect people in Missouri. Because I know everybody get a lot of frustration where, hey, we don't have hurricanes in Missouri. Why does that affect us?
Okay, you got to go back to 101.
Okay.
Insurance is basically the law of large numbers.
Okay.
And it's everybody puts money into this pool, into this insurance company, and then the ones that need it are paid out of that. If you live in Arizona, per se, you won't have ice damage on. You're not going to have probably hail. You're not going to have weight of ice and snow. You're not going to have some of the things we have here. We don't have wildfires here, but California does. We have tornadoes here. They generally don't. So we don't have hurricanes here where the southern coastal states do. So all that goes into play. And what happens when you have a bad year that a lot of those things happen, then that insurance company buys insurance called reinsurance. And it says there's two ways they buy it. They buy an attachment point that says if we have a claim over an example of $500,000, then that reinsurance or the company they buy insurance from then comes in and takes the claim from then on out and finishes it. Or if there's a catastrophe of $100 million or $5 million or whatever that attachment point is for that company in a certain amount of time or period, then that reinsurance company comes in and plays. Now we've seen so many natural disasters of huge amounts, it's hitting the reinsurance companies. The fires, the hurricanes, the massive damage by the tornado, like in Joplin, that wiped out. If that had gone through the country, it wouldn't have been near as bad. But it went through Joplin, and it was historic. I mean, it was just terrible. So those losses got pushed off to the reinsurance company. I don't know if everybody agrees with me on this, but reinsurance companies generally are not real risky. They're not risk-driven. They're risk-driven, but they don't have a lot of exposures. What I mean, it doesn't take too long for them to build their surplus back because they come to the insurance company and said, maybe ABC Insurance Company, we spent out this $400 million on your stuff and your attachment point's $500,000 and your premium's X number of dollars. Well, we're going to raise your premium a little bit. We're going to raise that attachment from 500 to $1 million, which means now insurance company ABC is on the claim up to the first $1 million instead of the first $500,000. Mm-hmm. Plus their reinsurance is going to be the same or more. So that's greater exposure to the surplus of company ABC, right? Mm-hmm. Because they're going to have to pay those claims out of their pocket. They didn't cede it off like what we do, like we do as a consumer. We cede off that financial exposure to the insurance company. We take our $500 and buy $50,000 worth of coverage, and it takes a long time at $500 to get to $50,000.
So when it goes up with the reinsurance, it goes downhill and gets passed along to everybody.
It has to.
Gotcha. So talk about, nobody wants to talk about this. How do insurance companies make money? And should we look at that as, hey, this insurance company is a monster. They shouldn't be making money on us. But on the same token, if the insurance company wasn't profitable, how would they pay claims? So tell me about how insurance companies make money.
Well, let's talk about two types of insurance companies first, okay? There's two basic types. There's a mutual company and a stock company, right?
Okay.
A mutual company is owned by its policyholders. So the idea of a mutual company is that it has to remain profitable to provide insurance for its members, right? Its policyholders. A stock company has to do that too, but it also has to pay stock increased value or dividends to the stockholders. Now, sometimes you'll have a stock company has a limitation on owners, so it's not as big as one that's maybe publicly traded or has a lot of stockholders on it. So, but they're generally bigger. They have more access to cash because they have the investment of the stockholders. So if they get to where they need money, they can sell stock, they can do things which a mutual company can't do. That a mutual company is based on just its performance within its policyholders. Okay? So they both derive money different ways, but premiums, everybody thinks premiums pay claims. Well, they don't, because there's also the expense of the product management, the product distribution, the building that they're in, the maintenance, the field person's car, the adjuster's car expenses, those type of things. Those expenses usually run 25 to 40%, maybe on the high end. It's what it costs to do business. So just use 25%, for example. That leaves 75 cents of every premium dollar to pay claims. Okay? So when a combined loss ratio and expense reaches $1, let's say, that whole 25 cents plus 75%, they're break even, right? Mm-hmm. Today's investment, what do you get if you invest $1 billion? 2 points, maybe 2.5 points. I don't know what the investment is because it's too big for me. But it's not a real lucrative investment, period, right?
Right.
So for them to put money back to take care of inflation, because their cost of material goes up when a car is fixed or a roof's put on a house or fire damages a property or wind, tornado, whatever. So they have to build inflation in. It used to be said that if you maintain a break-even 100% loss ratio and expense ratio total, and you're making a couple points on it, you're kind of just barely making it. Back in the day when investments were 12-15%, well, then that company could afford to go into a 105, 107%, maybe even up to 110% loss and expense ratio, because they still had another 5 points maybe they were making on investments. Mm-hmm. So that's a soft market. Usually when a hard market happens, those investments come down. So if they're sitting there and that trend was going at 110% loss ratio, let's say, and now they're only making 2% on the return instead of 15%, well, now they're losing, in that example, 13%? Or 8%, because we did 2 and 8. You're going to lose 8%, 8 cents on every dollar, and you've got $5 billion invested. So what's your choice? Cut benefits or increase prices, right?
Mm-hmm. Gotcha. So that's the investment side of it, and then there's underwriting profit too.
Yeah, the underwriting profit is basically what I was referring to,
okay.
about the claims expense plus the operating expense.
So you have underwriting profit is one way they make money, and then you have the investment side of it as well.
Yeah, and that underwriting profit can go up or down based on their return they make outside through investments, through growth, through, like I say, they can cut their expenses maybe. That's what you see a lot of companies do when you say, not just insurance companies, other places, well, we're going to consolidate from 40 offices to 20 and we're going to get rid of X number of employees. Well, look at Sprint. Mm-hmm. Okay, Sprint's a perfect example. The Sprint gets bought out by, what's the one that's buying them?
I can't think of it now.
Starts with T. T-Mobile. And T-Mobile buys them out. They're not going to keep 2 corporate offices, headquarters, right?
Right.
Do they need 2 presidents? They need 2 vice presidents, all this. So they're going to get rid of part of that and commingle part of that, right? Mm-hmm. Well, someone's going to lose. But those expenses go to the bottom line. So that way they wouldn't have to raise rates maybe if one's not doing as well as the other. They combine expenses and increase their profitability then.
Gotcha. So let's circle back to the start of that. You were talking about a mutual company versus
mm-hmm.
a stock company.
Right.
Is there one better than the other?
No. They each have their own place. Historically, stock companies are bigger. When you hear of the AIGs, the Travelers, Aetnas, those type of things, those companies you've heard of, that Hartford's that have been in business for 100 years plus, they're generally bigger. Nationwide is a mutual company. Auto Owners is a mutual company. And Nationwide is a company that has over $21 billion in assets, so they're a big company. But if you compare that to a AIG or a Hartford, that number might be $500 billion.
Gotcha.
Okay. Like I said, the strength of a stock company is if they need influx of cash, they sell all stock. Or they cut benefits back, they cut the dividends back or something.
But as far as how they pay claims or take care of a customer, is one any better than the other?
No, always more than one side to look at something. A mutual company that will tell you, hey, I owe more responsibility to my client because my client is my owner, my boss. Okay? But when it gets in the trenches, that adjuster employee doesn't think that way. He just has to go out and do his job.
And it's all based on the insurance contract.
Yeah.
So, all right, last one. Tell me about the reserve requirements that are put on insurance companies.
Okay. These are easy questions with a lot of answers. When a claim happens, let's go claims first. When a claim happens, the company usually looks at what's our maximum total we're going to pay for this. Like say, well, that car that we wrecked. We wreck a car and its replacement value is $20,000. So until that car claim is settled, they might reserve that at $20,000, thinking they may have to total it, even though maybe they can repair it for $10,000. But they don't know. A good friend of mine, a mechanic, says I can't see through steel, so you don't know what's there until you start tearing it apart. Mm-hmm. So the best idea is they get an estimate. They look at, okay, it's probably repairable, not going to total. So they start fixing it, but they put that money in reserve to take care of the things they can't see. Okay, where it really comes to play is like on a general liability claim where someone is injured and we don't know what those future medical costs are going to be, or if there's any disability that's associated with that accident. So maybe they reserve X number of dollars to take care of future bills.
Gotcha.
Okay, and they try to do that to guess at what the maximum dollar of that claim is, because then that comes along and affects that loss ratio we talked about earlier. Mm-hmm. Okay, and then there's some generally accepted numbers that determine whether a company is stable or not based on the amount of premiums written versus the amount of reserves or surplus. Surplus for insurance companies like the savings account for you and I. Okay, it's money you have sitting there, or the assets you have sitting there that you don't intend to use.
Gotcha.
Okay. Reserve requirements for other than claims would be, there again, it's that ratio between the amount of premium you have out there. Typically in the insurance industry, if you have $1 million or $1 billion worth of insurance premiums, if you have a third of that in surplus, and you're considered to be good, because not every policyholder is going to cancel their policy at the same time, like make a run on the banks like they did in the Depression. A good company, some of the best companies, like we have Cincinnati, and they're about a 1-to-1, which means they've been physically stable in keeping money in their hands, or assets in their hands, to be able to take care of their claims and so on. So I tell everybody, you don't need insurance the day you buy it. You need insurance when you have the claim. So you want to make sure that that company has the financial strength to take care of it.
Gotcha. Excellent. Anything else you want to share?
Not till next time.
Got it. You keep asking questions. We'll do our best to answer them.